Hi, I'm Kara Murphy, and this is Money with Murphy. After a bumpy first half of the year, markets found their footing in the third quarter. Broadly, stocks, bonds, commodities, real estate all posted gains, bringing all of those asset classes into positive territory year to date. Nearly every equity sector in the S&P 500 stock index was up as well, with the only exception being consumer staples, which dipped slightly. But the third quarter didn't pass without its challenges, particularly on the economic front. Stocks around the world enjoyed strong gains after a turbulent second quarter. As tariff fears receded from headlines, Congress passed a sweeping new tax bill, and the U.S. dollar remained stable, all helping to push U.S. equities ahead of non-U.S. developed markets such as Europe and Japan for the first time this year. Meanwhile, emerging markets equities posted strong gains in the third quarter, helped by strength in Chinese markets. Back in the U.S., the technology sector reported particularly strong earnings growth, driving nearly 60% of the year-to-date earnings growth in the S&P 500. These results were all the more remarkable given that the sector lagged in the first half of the year from competition on DeepSeek and from tariff announcements. In the meantime, infrastructure spending related to artificial intelligence boomed. As corporate earnings remained resilient, the job market appeared to weaken as the number of new jobs created on a monthly basis cooled compared to its pace earlier this year. As a result, in the third quarter, we downgraded our view of the labor market into the softer part of neutral territory. The silver lining of a softer labor market was a more accommodative Federal Reserve, which cut interest rates after nearly a year-long pause. Helped by that rate cut, bond yields of varying maturities declined, which in turn pushed up bond prices. Looking ahead, investors and Fed officials will be watching the job market closely, though that task will be complicated by the government shutdown, which limits many data releases from government agencies. Currently, the market anticipates 2 more interest rate cuts through the end of the year. And with third quarter earnings season being the last of 2025, investors will be paying close attention to what companies say about the road ahead. When will we see returns from massive AI infrastructure spending? How tariffs might be affecting profit margins? And what CEOs anticipate going into 2026. Until next time, invest wisely and live richly.